There's a retirement account called a defined benefit plan that lets a self-employed business owner shelter up to $330,000 a year, completely legally. And your financial advisor will never tell you it exists. That number is not a typo. $330,000 in a single year, off your taxable income. Your 401k caps out at $23,000. Your IRA maxes at $7,000. And somewhere right now, a 52-year-old doctor with a private practice is sheltering 14 times that amount, paying almost nothing to the IRS and building a tax-deferred retirement war chest that most people don't even know is possible. By the end of this, you'll understand exactly how the mechanism works and why no one has ever put it in front of you. Let's start with what you probably know. Most people retire broke, not because they didn't earn enough. Because they were never given the tools to shelter what they earned. The 401k was created in 1978, and even maxed out, it barely dents what a high-income earner actually owes the IRS. The IRS takes its cut first. You invest whatever's left. That's the system they built for you. What they didn't teach you is that there's an older, far more powerful structure, one that predates the 401k by decades. One that the IRS not only allows, but actually designed to let business owners shelter income that would otherwise get wiped out at the 37% bracket. It's called a defined benefit plan, and it's the closest thing to a personal pension you can build from scratch. Here's what it is in plain English. A defined benefit plan is a retirement plan where you, as the employer, promise yourself a specific monthly income in retirement. The IRS then lets you calculate exactly how much you need to contribute each year to fund that promise, and deduct every single dollar. Because the contribution is tied to your promised benefit, and because that benefit depends on your age and income, the older you are and the more you earn, the more the IRS lets you shield. A 45-year-old consultant earning $500,000 can contribute over $200,000. A 55-year-old physician. Closer to $330,000 every year. Every dollar deducted before the IRS sees a cent. Here's how it plays out in the real world. Say you run a profitable business and you're clearing $400,000 a year. You max your 401k at $23,000. You're still staring at $377,000 in taxable income. At the 37% federal rate, that's nearly $140,000 going straight to the IRS. Now you open a defined benefit plan. Your actuary, and yes, you'll need one, calculates that you must contribute $220,000 this year to fund your promised retirement benefit. You make that contribution. It's fully deductible. Your taxable income drops to $157,000. Your tax bill gets cut roughly in half. And that $220,000 sits in a tax-deferred account, compounding quietly until you retire. But here's where it gets interesting. The people who use this aren't just doctors. This is the structure behind the low tax bills of lawyers, real estate developers, franchise owners, and high-earning sole proprietors who seem to pay almost nothing year after year. And it's not illegal. It's not a gray area. The IRS literally publishes the contribution limits. It's just that not one teacher, not one guidance counselor, not one moment in 12 years of school ever mentioned it existed. Because the financial system doesn't profit when you pay less to the IRS. Now the caveats, and this part matters. A defined benefit plan is not for everyone. You need consistent, high income, typically $150,000 or more, and you need to commit to making contributions most years. If you have employees, you may be required to fund their benefits too, which changes the math entirely. Setup costs run $1,000 to $3,000 up front, with annual actuarial fees on top. But the IRS actually wants you to do this. That's the reframe. They wrote it into the tax code. For the right person, this isn't a loophole. It's the single most powerful tax deferral vehicle the code legally allows a private individual to operate. And remember that $330,000 figure from the beginning. That's not the ceiling. That's just the defined benefit plan alone. Because here's what nobody mentions. You can stack this on top of a 401k. Run both simultaneously, which means some business owners are sheltering over $350,000 a year in combined contributions, legally every year, compounding untouched while everyone else writes the IRS a check. The question isn't whether this is real. The question is why, in all the years you spent in school learning things that mattered far less, not one person thought you deserved to know it existed. There's a related move these same owners layer on top of the defined benefit plan. It lets them pull money out of these accounts completely tax-free, even before retirement age with zero penalty. That's the next file.